Today, we're bringing on mortgage industry expert Andy Walden from Intercontinental Exchange, ICE for short. He'll help us make sense of what is going on and what opportunities are on the horizon for real estate investors. I'm Kathy Fetke, and welcome to The Real Well Show.
You're listening to The Real Well Show with Kathy Fetke, the real estate investor's resource.
Each month, ICE releases the monthly mortgage report, a critical look at how mortgage applications, refinancing, and home pricing are shifting in response to economic conditions. In this conversation with Andy, we'll break down the latest data, what's happening with interest rates, what asset classes are seeing some hardship, and what markets are rebounding. Andy, welcome to The Real Well Show.
Thank you. Appreciate you having me.
Before we get started on all the exciting things happening out there in the economy today, tell us a little bit about the International Exchange and what you do there.
Yeah, I head up the mortgage and housing market research team here at ICE or Intercontinental Exchange, which effectively means I get to play in a pretty extensive sandbox of data, whether it's our home price index, mortgage origination data, mortgage servicing data, to really kind of get a holistic view of what's going on out there in the mortgage and real estate worlds and share them both internally at ICE and with folks like you. So happy to do that today.
And ICE was formerly Black Knight, is that right?
ICE acquired Black Knight. So I came over through the Black Knight acquisition, spent about 10 years at Black Knight, and I'm excited to be at ICE. Yeah.
Okay. All right. And you come out with monthly reports. What's going on with this last report?
Oh my gosh, a little bit of everything, right? In the latest report, we dug into a recent enhancement that we made to our home price index. And so we really used that as our lens into kind of all things that are going on with the housing market right now. And I think some of the key takeaways when I start to look at kind of a broader lens of what's going on in the market this spring are more inventory, which I think is good news for folks that have been really inventory starved in markets that have been really inventory starved in recent years. We've got about 28% more homes available for purchase than we had at this time last year. We're in our best position that we've been from an inventory standpoint in about 5 years. And so that needle is moving in the right direction. It's leading to some softer home price dynamics. And so one of the key things that we're seeing right now is the rate of growth in home prices has started to cool off a little bit over the last couple of months. And one segment of the market that really stands out to us is that condo segment, where if you look at some of the early data for March, suggests that condo prices are actually slightly down from the same time last year. So certainly some moving needles here when we look at the housing market and some inflections as we make our way into this spring.
So you packed a lot in there, but I just want our listeners to really hear what you said at the beginning of that, which was inventory is increasing, and that's a good thing.
Yeah.
Because so often headlines just are meant to scare us. You know, that's how they get viewers. And the headlines have been, oh no, inventory is rising, market crash coming. And you just said the opposite. It's like, we came from the lowest of lows in inventory, too little. So An increase is a good thing. Why is that?
Well, I mean, when you look at I tend to look at it from a home affordability standpoint, right? And one of the keys to a better affordability dynamic, one is possibly a little bit lower interest rate environment, but two is seeing the housing market, which has been running red hot, as we all know, and significantly outpacing incomes out there in the market. One of the ways to normalize home affordability is to see incomes catch up and keep up and surpass home prices for a period of time here to bring the market back into a little bit more normalcy, if you will. And really the path to that is more supply out there in the market. We haven't really had a deficit of demand, especially when you look at the 2020, 2021 years. It's really been a deficit of supply that's been leading to some of the challenges that we've had out there in the market. And so that increased supply is allowing home prices to soften up a little bit. You've got 2/3 of markets that are now running below their 30-year average in terms of price growth. And it's allowing things to move in the right direction from a home affordability standpoint.
Yeah. And then again, for our listeners, what you just said is that home price growth is slowing. It is not necessarily negative, at least on a national level.
On a national level, you're absolutely right. Yeah, there are about 15% of markets, primarily in the Sun Belt region, where you're seeing home prices actually modestly come down from the same time last year. We all know the Austin market dynamics, and prices in Austin about 18% off of where they peaked a few years ago. So there's some markets that you could call it corrective if you want to. But most of what we're seeing right now is just a cooling pace of growth, and a handful of markets that are 0, 1, 2% down from where they were at this time last year.
I mean, Austin still has the same fundamentals it had before, a few years ago, right? So it seems like a buying opportunity, if anything.
Yeah, the interesting dynamic that happened in Austin, and this happened in a few markets across the country, was a lot of migration in. So it was outside money affecting local home prices. You saw folks moving from California into Texas. You saw something similar in the state of Florida, where it was external money impacting local home prices. Now these markets, with migration slowing really largely across the country over the last couple of years, it's more local income that's supporting local home prices. And so, yeah, those dynamics have changed a little bit. But you've certainly seen the affordability dynamics in Austin move in the right direction here, as you've seen prices come down from where they were in 2022.
And if you could just explain how you calculate housing inventory, for those who are new.
Yeah, so we're just looking at the number of homes available for sale at any given time. And the benchmark that we really use is going back and looking at same month averages from 2017 to 2019. It was more of there's never a really normal period in the housing market, but a more stable period before you started to see the impacts of the COVID pandemic really start to affect almost every major market across the country from 2020 through today. And so we're looking at that pre-COVID era, if you will, and same month averages of listings to see, okay, where are we at today in terms of the number of homes available for sale, available for purchase, compared to where we were in the years leading up to the COVID pandemic.
And how does it compare? Are we still have less inventory than between 2017 and 2019?
We do nationally, right? So overall, inventory is up about 28% from where it was the same time last year. We're running about a 20% deficit. Which, when you kind of compare it to the 50, 60% deficits that we saw in 2020 to 2023, is a significant improvement. We were at this time last year, for a historical comparison, we were at about a 38% deficit in terms of supply. And so you've materially seen that needle move in the right direction. When you start to look at it at a more local level, you have about a quarter of markets moving up towards a third of markets that are now fully back to those 2017 to 2019 averages, and a little over 15% of markets that are actually running more than a 15% surplus. So a wide array when you start to look geographically across the country, a lot of various inventory and home price dynamics at play. But nationally speaking, we've been moving in that right direction pretty consistently over the last 3 years, still about 20% shy of where we should be.
So what do you say to the people who write in the comments, and I know they will, prices are at all-time high, the housing market is due for a crash?
Yeah, I mean, there's a lot of dynamics. And when you look at home prices and you put them in context with incomes and interest rates, it's a challenging affordability dynamic. There's no two ways about it. And you can make an argument that the housing market and asset values are overvalued, just like you can in the equities market out there as well. That doesn't necessarily mean home prices are going to crash, right? There's a number of various ways that market dynamics can shift to bring us back into longer run affordability, whether it's improvements in 30-year interest rates, whether it's home incomes, outpacing home price growth for an extended period of time. I mean, if you look at the last time home affordability was at this level, it was the late 1970s, early 1980s. And in the wake of that period, you actually didn't see a massive home price correction. What you saw was interest rates come down at that point in time and normalize the market. The other time period that we saw affordability near this level was obviously 2006. And you did see prices move downward at that point in time. So there's no guarantee in terms of the path in which the market normalizes here, whether it could include some home price declines, whether it'll be more of an interest rate dynamic, or whether it'll just be an extended period where home price growth slows and incomes outpace home price growth. But certainly, when you look at the fundamentals, there's some challenges out there from an affordability standpoint. There's no doubt.
Yeah, I mean, the big difference between now, there's so many, but the big difference between now and 2006 is that those loans were adjustable. People never could have qualified for those loans had they gone through a normal process like today, or I should say a qualified mortgage process to prove that you actually can afford the payment. People in today's mortgages are, well, first of all, they're fixed rates, not adjustable.
Mm-hmm.
People had to really show every document they have to be able to get that loan and prove that they can make that payment. It's very different.
Yeah. Yeah, much stronger mortgage base sitting underneath, higher credit score. I mean, all of the things that you just mentioned. And we've historically gone back and done that comparison. Okay, what does this look like versus 2006? And it's a very different underlying dynamic in the mortgage market, a lot more strength underlying today's housing market than certainly you could call it a house of cards that was kind of built under the market in 2006.
Yeah, I mean the difference again was like their payment adjusted and was bigger. People who own homes today are in a fixed rate at a very low payment, very low interest rate.
Mm-hmm.
But coming back to interest rates, where are we today? And are you? I know rates are down a little bit. Are you seeing more mortgage applications?
Yeah, so interest rates as of last Friday came down into the 6.5% range after the most recent round of tariff announcements. That's the lowest that they've been since October of last year. And so you are seeing a little bit of an improved interest rate dynamic. The other place that we like to look in terms of kind of near-term outlook for mortgage rates and what the smart money is kind of pricing into the market right now is our ICE futures data, where 30-year mortgage rates are traded similar to other commodities, whether it's pork bellies or corn or soybeans. 30-year mortgage rate futures are also traded out there in the market as well. And it helps originators kind of hedge their pipelines. When you look at the futures pricing on 30-year mortgage rates, what it suggests is that the market is kind of penciling in mortgage rates to come down even a little bit further here as we make our way through the next 6 months. So going from the 6.5% range where we're at right now for the traditional 30-year fixed rate conforming loan, maybe down into the 6.25% range by September. Now, a lot's going to happen between now and September. Those dynamics will most certainly change, but that's currently what's being priced into the market from an interest rate perspective.
So what you're saying is all this craziness that we're dealing with is actually good for mortgage rates and housing.
Yeah. I mean, certainly to some degree. Right now, if we see a recessionary risk, that could change underlying dynamics out there. They could change demand, especially if you start to see some labor market pressures there in terms of how much money folks have to spend and whether they're employed and can qualify for a mortgage. So that can change your subset on the demand side. But certainly, just simply looking at interest rates, you've seen some downward movement in interest rates given some of the recent turmoil in the markets.
Yeah, and I keep saying, along with Barbara Corcoran, that when rates come down, you will see people come off the sidelines. And I don't know yet if that's happening, but it seems like you said, price growth is slowing. So
Yeah.
housing's a little bit more affordable. Wage growth has been pretty good.
Mm-hmm.
And then when mortgage rates drop, that just brings in a few more 100,000 people who can afford to buy, right?
Yeah, and when we measure that a couple different ways, right? We look at rate lock activity flowing through our origination channels here at ICE. We look at purchase mortgage application volumes and how those are flowing through the systems as well. And if you plot just take mortgage applications, for example, to purchase a home. If you plot those next to interest rate dynamics, they've been ebbing and flowing right along with interest rates. So to your point, as interest rates have been coming down, it's priced more folks into the market and it's making buyers a little bit more active there. So you have seen some response to falling interest rates in terms of increased demand out there in the market, at least recently. Now, it'll be worth watching that, especially as we move forward here. If tariffs stay in place, does that dynamic change? Do we see any change in home buyer sentiment or demand or labor market factors there that could impact mortgage applications? But right now, you've been seeing them ebb and flow right along with 30-year interest rates.
So we talked a little bit about areas that have been slowing down or where we've seen price declines. Are there areas where we're seeing picked up activity and potentially less inventory and prices increasing faster?
Yeah, there's kind of this bifurcation of the market right now where it's the Sun Belt region, the southeastern portions of the market from Florida all the way over to Texas and even up into Colorado now. You've seen inventory returning. You've seen new construction that's helping put some supply out there into the market. Those are the areas where you're seeing softer home prices. When you look at the Northeast and Midwest portions of the country, that's where the opposite dynamics are taking place. You're still seeing very deep inventory deficits. The Northeast, some markets are still 60, 70, 80% short in terms of the number of homes available for sale. You're seeing much firmer home prices in those areas of the market. And the same dynamics to some degree are at play in the Midwest. It's not quite as severe in terms of inventory shortages, but still 40, 50, 60% short in some of those Midwestern markets. And so when you look at home price growth rates, 14 of the 15 fastest growing markets from a price perspective are in that Northeast and Midwestern region of the country. And when you look at the bottom markets where home prices are either flat or modestly down from last year, it's those southeastern regions up through Colorado where you're seeing softer prices or even prices coming down a little bit.
Because builders really flocked to those areas, but not so much to the Midwest. They probably can't.
Yeah, exactly. Yeah, the bulk of what's coming online from a new construction standpoint going on in the southeastern portion of the country. And the same goes, I think we talked earlier about condos versus single family residences as well. When you look at the number of multifamily units that came to the market last year, pretty significant surge there, and it's causing a little bit softer dynamics in that condo space as well. And you very closely see that down in Florida. Now, there's a number of different dynamics there in Florida as well, with hurricanes that came through last year, damaged a lot of those properties. You have no new condo rules in place that are increasing regulatory scrutiny of condos in Florida as well, which is causing some price flattening or softening in those particular markets as well.
Now, what about delinquencies? Again, there's the people on YouTube, so YouTube experts, quote unquote, who keep seeing this market crash and delinquencies on the rise. Is there any truth to that?
So when you look at mortgage delinquencies, as of right now, it's about 3.5% of all mortgaged homes in the U.S. are past due on payments. You kind of look at that over the last 25 years, and what you see is that's about a full percentage point below where we were in the early 2000s. It's almost a full percentage point below where we were in the 2014, 15, 16 timeframe as well. So historically speaking, mortgage delinquencies are still pretty darn low, and we're just coming off record lows here over the last couple of years. They are modestly rising right now in terms of overall delinquency rates. And it's very acutely happening in certain segments of the market. So, for example, the FHA subset of the market, you're gradually seeing delinquencies rise right there. And that was kind of expected to be the canary in the coal mine for the mortgage market over the last few years. As we start to see delinquency rates rise, there really hasn't been a whole lot of private label securitization lending like we saw the last time around. One of the few places that you've been able to gain access to homeownership as a lower income or lower credit individual in recent years has really been that FHA market. So it's no surprise to see that segment of the market turn. And you're starting to see a little bit of a pressure there building at the lower end of the lower end of the income spectrum. When you look at the more mainstream mortgage market, you look at, your Fannie Freddie securitizations, you look at portfolio held lending that's held by banks or credit unions, delinquency rates there are effectively flat from the same time last year. So overall, mortgage delinquencies are trending up a little bit. It's happening in certain pockets, especially folks that maybe make less money, have lower incomes, have lower credit scores. You're certainly seeing a little bit of pressure building in those segments of the market. But overall, delinquency rates from a historical perspective remain pretty low.
That tracks. Well, with all of that, what kind of opportunities do you see out there for investors today?
Yeah, I mean, whenever there's volatility, there's typically opportunity that comes right along with that. If you look at it from a geographic perspective, it really depends, your risk tolerance and those types of things. But you're certainly seeing volatility and potential some downward pressure and prices down there in Florida and Texas, where perhaps you can buy at the lower end of prices there or as prices decline. If you're looking for a little bit more firmness in prices, the Midwest and the Northeastern markets are areas that still have those deficits of inventory where prices are still remaining firmer. And then when you start to look at it from a potential homeowner perspective, I mean, you can look at a wide array of affordability analytics, what geographies, if you're someone that's mobile and can move to different areas of the country, certainly more affordability in the Midwestern region of the country as well. And then you kind of look at opportunity potentially for those folks that bought, marry the home, date the rate dynamics that have been in place in recent years of folks that are buying and expecting to be able to refinance. That opportunity hasn't come to fruition yet, but certainly, a little bit of door opening there towards the tail end of this year where maybe interest rates come down a little bit. There's potentially some opportunity there for some refinance activity.
Good stuff. All right, Andy. Well, thank you so much for being here on the Real Wealth Show. It's been really awesome.
Yeah, I appreciate you having me. Thank you.
And thank you for joining me here on the Real Wealth Show. If you're interested in the Midwest, it is a great time to invest. We have a builder in Oklahoma City. We also have an incredible team in Cleveland, Ohio that does renovations. They have property management in place. a wonderful team in Indianapolis with new and renovated homes. You can find out more at realwealthshow.com. Just click on the Invest tab and you'll see a whole list of areas around the country that are a great opportunity for investing today. Again, that's realwealthshow.com. I'm Kathy Fedke. Thanks for joining me. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.